Live streaming is on.
Good afternoon, everybody. It's that time again where we will have our trader strategy meeting. We're going to bring our whole team on board, talk about what we're seeing, and boy, do we have a lot to talk about. Lots of volatility moving and shaking here in the markets. And therefore, I'm going to start things off with Brett Manning, aka Chart Trader. Good morning, Brett. How are you?
Good morning, Jim. Doing great.
So we've got a lot of moving pieces going on here, but if you could pinpoint what you think is the most important dynamic in play right now, what would that be?
So, well, first of all, last time we talked about in our last strategy meeting, we talked about the possibility that we might see a fresh kind of blow off type of a breakout in the U.S. dollar, and really that's about getting closer and closer to the UK and the EU having to figure out how to deal with the insane energy price inflation headed toward the wintertime, and we all know what that's about in Russia and natural gas. I mean, we've seen that take place, but I want to get into the weeds a little bit because I think it's really important for people to understand some of the dynamics that are happening, because I think there's a lot of other risks out there. And we're going to talk about option market positioning and some of the all-time records that we're seeing there, and I think why some of that's going on. So to set the stage, I want to go back to something we talked about in our strategy meeting. I think it was in January. My case then was that we were heading into a bear market. It's based on removing the two pillars of support. We've talked about this in other strategy meetings where the stock market really come to depend on the Fed, ultra low interest rates, and flows from other sources that don't typically participate in equities. When you get an equities pullback and you get the dividend yield on the S&P well above like the 10-year. So these are really good cushions that we've had in place for a long time. But once the inflationary regime set in, interest rates took off, you no longer have that dividend yield ratio, and the Fed couldn't be there to provide extra liquidity when there's financial market volatility. So that really explains, I think, where you start to go into to the bear market in equities. But the other big point I made then, and I think this is really starting to become important, is that rising and volatile interest rates, that's a mode of behavior. That's a type of world that the current financial world that's been in existence, let's say, since the global financial crisis, that it's acclimated to a world where we're just not situated to deal with rising rates, volatile interest rates. Most of the world's money is now managed by people who've never seen a world that looks like that or works like that. Most of the strategies in play, like we just saw in the UK pension system, and I'm going to go into that a little bit more because I think it's a really instructive example. These are strategies that were acclimated to a different world. And the metaphor that I've used in the past for this is the difference between looking at like a mountaintop lake ecosystem versus an estuary ecosystem. And fish that evolved to live in the mountaintop lake, they're used to no volatile conditions. They're used to no salt in the water. If you scoop a fish out of there, throw it into an estuary where there's salt and everything is volatile and constantly changing, the fish can't possibly survive. And you can just use that as a metaphor for the types of strategies that we have in the financial world. They're acclimated to interest rates that barely ever change and they stay really low. And we've had that situation in place for so long that you have whole careers and regimes, major institutions that have acclimated to that kind of environment. And we're talking about more than a decade of that constant steady state dynamic suddenly breaking out and changing into a completely different world. And the way that I put it then is that kind of dynamic, because everything is kind of situated around this premise, that kind of dynamic means something is going to break. And that's the way I put it back then. And I would say the UK's bond market crash over the past week is really maybe the first example of that happening. The UK pension system was set up with new rules, new managers, controlling tons of capital, all of it designed to work under the conditions we've had in place since 2008. The rule changes that they've had assumed, at least implicitly, that kind of environment. And the people who were rising to the top, the rising stars in that industry, they were people who were willing to take advantage of that kind of environment, and their strategies were predicated on that kind of environment. So pension funds were carrying huge exposure to long dated gilts, UK bonds. They levered up that exposure because bonds never sell off fast. So you can just lever that up. You can make more money that way. So they owned tons of swaps where the bonds they owned were collateral, right? And swaps mean counterparty risk. We all remember AIG, right? Then it was levered up swaps with mortgage-based bonds as collateral. Now it's swaps with gilts as collateral, but it's really kind of the same dynamic, but it's leverage. It's people finding a way to make a lot of money out of something that barely ever moves. So with UK inflation at 10%, government announces a new stimulative program to push tons of money out to help households and businesses survive crazy energy prices, and the bond market couldn't handle it, and it started to fall. That devalued the collateral the pension funds had put in to get levered returns on the swaps, and the counterparty said, now you got to send us lots of money because your bet went south. And the only way the pension funds could respond to those margin calls was to liquidate their bonds. So they had to generate the cash, so they had to pay the margin calls. That's a feedback loop, and that's a crash, right? That's what we saw in that market. And that's an example of something breaking. And the point that I want to make is the way this has been covered in the financial media is if it's a very specific and unique situation to the UK, and that's wrong. And that's the main, if I had a main thesis statement for this meeting, that premise is wrong. The specifics don't matter that much. The point is that there was a strategy in place that was designed to work well in a world where certain assumptions had defined the landscape for a long enough period of time. And now those assumptions are breaking, and there's a different kind of world. Low and stable interest rates mean you can use lots of leverage and everybody gets rich. If you think that's only happening in the UK pension system, you're crazy. So strategies like that all around the world in all different places are sitting on the brink where if one more variable enters the equation, like the new program that the UK government did, it broke the situation just enough to tip it over that brink. And suddenly what was exposed is a strategy that can't work in a world where interest rates are higher and volatile, and there's the possibility that there'll be bond vigilantes and that there'll be all sorts of other processes that are going to start to identify that weakness and that are going to try to break it. Just as SCALP has talked about recently, like you've got people who would make a lot of money off of those sorts of things. You find the vulnerabilities and you target them and you break them. We saw the same thing in 2008. We're seeing the same thing right now. It's not a specific UK thing. It is the fact that there are all sorts of systems with trillions and trillions of dollars all around the world that have been designed to work in a world that was very consistent and stable for a very long period of time, and is suddenly radically changed into something different. And those strategies are all going to be vulnerable. And so it's not going to be the only thing to break. So what could break next then, you start to think? I'm starting to lean toward sovereign spreads in the EU. I talked about this in my notes this morning. I mean, how is Italy going to survive the Russian winter with 10,000% inflation in its natural gas prices? Are they going to do a fiscal expansion program? Italian rates will spike. Germany's probably won't. Bear funds will be loading up with credit default swaps to push them wider. What does that mean for the euro? What if that caves the euro further? What does another wild dollar spike do to the world? How do countries with dollar-denominated debt service that debt when they don't have a printing press and they got to price everything in dollars, and dollars become impossible to find? Are we finally to the down cycle where the crisis is at the government debt level rather than Wall Street debt level, corporate debt level, or household debt level? Because it kind of seems like we've cascaded up those different layers, and now we're at the one where it looks like, to me, it's at the government debt level. These are all huge questions, and there's a lot of big risks that are still looming out there, and they could take us to a darker place. But usually people find a way. So I'm going to kind of counter all of the mood of all of that. I want to lay the foundation because that's all real. But I want to counter that a little bit because the reality is, if you've been doing this for long enough, you know that people find a way to muddle through most of the bad things. And most of the bad things that people worry about don't end up actually happening. And even more importantly, at the end of the day, I'd say rule number one to all of this stuff when you're looking at sort of big picture macro risks is, people tend to think that the bottom layer of the whole thing is financial, that's the end all be all. And if it doesn't work financially, then there's a problem. And that's wrong because it's actually political. And all these things happen because of rules that are in place. And if everything is going to get that bad, what happens is we change the rules. We saw this with Bretton Woods. We saw this with the Plaza Accord. There's been a number of instances historically where, there's a sort of world on the brink moment and people just say, you know what, we're just going to change the rules and then it's going to be okay. And so at the bottom layer is political. We need to have some kind of coordination to make that happen. But in the meantime, so big picture, we've got a lot of risks sort of to the financial firmament, sitting around in the shadows, waiting to jump out and go boo. It's not just the UK pension system. There's probably lots of other things that can break. And there's this sort of strategies that have been put in place. They're on the brink. And if another variable is added, they can start to break. Once that gets exposed, people start to go after it. The blood's in the water, etc. But that's why I would say we also have all-time record put option ownership right now across the market. This is the most hedged equities market in history, including around like Lehman blowing up in 2008. This is more hedged. People are aware of what I'm talking about. And these are large option traders. This is 200 million here, 200 million there. This isn't mom and pop trading options. This is major big players with more information than you or I have, loading up on enormous put positions over the last several weeks. And I would imagine it has more to do with what I'm talking about now than maybe a nuclear bomb risk or even maybe the Fed. If we see a break in inflation, given that positioning, if we see rising global recession risk and everybody pours into bonds, that alleviates a lot of these risks. And suddenly you get that de-hedging wave and you've got maybe a long-term bottom in the market as everything gradually kind of, the sun comes back out, people start to take more risks. So understanding these risks is important, but it's also important to understand the way that the market is positioned right now, because the market is positioned to hedge for some pretty bad things happening. People are really expecting some really big bad things to happen, but they're already in, again, all-time record hedging positions around those types of concepts. And just lastly, from a trading standpoint, if we boil it back down to what we do every day, I kind of hate this market because I want to be shorting, and I'm just not built to be on the same side as a very crowded market. And right now is about as crowded as you can possibly get on the short side. So there's my kind of big picture and what I think is the most important type of dynamics at play right now.
Yeah, we do have a tricky dynamic indeed. I was just looking at the AAII sentiment that came out last night, and we're still in very bearish territory. We had, I think last week it was 60.9% bearish. It was an uptick to 60.8% bearish. So things didn't really change, and that does give us the vulnerability for short squeeze. So I suppose you would be looking to maybe ride a short squeeze higher, or you're looking for trading setups and patterns that would give you that?
So the way that I described it yesterday, I think it was yesterday. So when you have a really lopsided sentiment, the one way that can sort of not matter is if the equities market is really lagging and following other markets, and there's not as much trading and sentiment impact on what happens in bond markets or in currency markets. And if the dollar takes off and bonds tank and rates go through the roof, we're not going to get a squeeze in equities. So it's primed there. If something improves about the situation, there could be, an enormous squeeze in the stock market. But we need to see some factor come in and be a little bit of a game changer to alleviate these risks. It's either a drop in inflation, and one that sort of looks like, hey, wait, we're heading into maybe like a mild global recession, and the inflation is going to be taken care of by that rather than just endless hiking by the Fed. And the Fed can kind of be aware of that and start to break its position a bit, and everybody just floods into bonds because of the demand for bonds from a natural market dynamic. It alleviates lots of these risks. Again, it even helps Italy deal with the winter. So there's a lot of things that could be helped by that sort of dynamic. Or another possibility is we start to see a better response from markets as some of these fiscal programs are rolled out in the EU, and we start to take off the table the risk that there's going to be just a really, really painful recession in the EU over the next, let's say, 2 quarters. I think that's another type of thing. If it just looks like it's just more feasible. And I guess some of the stuff on the ground with the Ukraine and Russia. But there needs to be something that allows people to say, I could be wrong to be this hedged, and I might be missing out on something important, and it just cascades into a feedback loop. But again, you saw a patch from the Bank of England coming in and buying gilts. It's important to recognize also that in a bear market, for those of you who haven't experienced bear markets before, there's a dynamic that I call, and not just me, lots of people call the slip of hope. So what you get is a downward trend filled by little spikes to the upside, where each one of them is some kind of patch catalyst, some kind of policy shift that comes out that doesn't really solve the core problem, but just kind of treats one of the symptoms. It's a really common dynamic, and everybody getting, oh, maybe this is the bottom because this happened, and you get that squeeze, and then you're right back at the lows the next day, kind of like we see today.
All right. Well, we are at the end of the quarter, and that means earnings season is right around the corner. And we saw Jeffries come out, and I know event trader Gavin, you like to look at that one as a read through as it kicks off kind of the financials that we have probably about 2 weeks or so away. So as we approach earnings season, what's your early take as far as that Jeffries report goes?
For the banks, I mean, it's certainly pointing towards a difficult environment, which I think a lot of people were expecting. The equities side of things certainly outperform the fixed income when we're looking at the IBs, but overall fees are going to be well down. Now, we knew this coming in, given the comments that we got from the Barclays conference, with a lot of people talking about investment banking fees being down 45% year over year. So I would view the Jeffries as a better than feared number, but I think this is the problem that you're going to kind of run into with a lot of things when it comes to earnings season. And it'll be interesting to see how the dynamic plays out in the markets, where right now you're looking at people are slowly starting to cut down their estimates. Now, there's an argument being made that they haven't cut them down enough, and we'll certainly see that come up. But usually they lay out a pretty low barrier of entry that allows for these companies to beat. So I'm getting the feeling that a lot of the figures that we're going to be talking about over the next couple of weeks are going to have that better than feared dynamic, similar to what we saw in Q2. Now, this was able to help provide a little bit of a boost. If you recall, we were getting that June bounce off as we headed into earnings season. Apple and Microsoft were two names that I know stood out for having excellent reports that really got people excited and started, painting the idea that maybe things weren't as bad as expected. And we see a lot of commentary along those lines with the economic data too. However, everyone keeps pointing to 2023 as being when the real shoe's going to drop. That's when we're going to get a bigger impact coming from the rate increases that we've seen gone through. So I'm going to be curious to see how people react to what could be a decent round of earnings and a decent round of economic data over the next couple of weeks, and whether or not, given the positioning that we've talked about, given the sentiment that we've talked about, that clears the way for a little bit of a run into the end of the year. Now, I think something like that is something that would really excite Brett on the short side, and I would have to agree with that in terms of, if you squeeze some of the people out of these positions, it would allow people to reload on the short side at a higher level, and then that would be something that we could see a little bit more aggressively with the sell-off and fresh lows at the end of the year. But this earnings season's just setting up as a pretty key dynamic, especially when you're looking at a valuation front, where right now I believe the 2023 outlook for the S&P earnings is somewhere in the range of 230, which, if you're looking at that right now at 17 times, that would get us to 3,900, which really isn't all that far away. What's that, about 5.5% or so from the levels that we're at now? But I think what people will be watching closely is the guidance coming from these earnings, and seeing exactly how cautious people are going to get. Do we get the better than expected results, but then everybody cutting their numbers drastically for FY23 and for the final quarter of Q4 too? Or do we see them hold steady? And that's going to be a really big aspect that we're going to have to look at. But I think overall, in terms of the Q3 results themselves, it's certainly setting up to come in as better than feared. Now we're going to get two key readings on that this afternoon. Of course, with Micron out and Nike, key read on the semiconductor side and the consumer spending side for apparel. And that's going to be certainly interesting to see how the market reacts to that and how the results are overall. One thing that I will be avoiding is, and I'm going through and creating a list, is a list of companies that have an extensive amount of FX exposure for revenues and both earnings. So anybody with overseas, especially exposure to Europe, I think you're going to see some really poor reports. So, that's going to be one thing that I'm looking at going into earnings. But overall, I'm really curious to see how the markets react, and we should be able to get a little bit of a early read this afternoon with Micron and Nike.
All right. So why don't we take the opportunity to bring in Blue Chip? You've been bobbing and weaving quite a bit here. Threw on a short in Tesla. I think you're long the Nasdaq now, so kind of hedging both ways. So explain what you're doing. Little bobbing and weaving.
Yeah, let's focus on volatility first. The VIX is trading back above the 30 mark. And as I've talked repeatedly over the years, I use the VIX as a risk management tool where the higher it goes, the more fluid and looser I have to be with my analysis when I interpret the charts around key support levels, key patterns, just because it's the nature of the beast. You're going to get just a lot more emotions involved on with the market, with the price action, and liquidity tends to dry up. Market tends to be a little bit more risk averse on those when the VIX is rising. And when you're above 30, you're in that fear mode of the market. You're in that mode where a lot of the activity comes fast and loose, and you have to either adapt or sit on the sidelines. That's really what it comes down to as a trader. And for me, it's really just been cutting back on position sizing. You're going to get the bang for your buck anyway. So I've always just kind of managed to just reduce my share size, taken on a little bit more of a scaling in approach around key price levels, usually associated with the S&P index coming down to a pivot support level or a key technical level on an intraday chart. And then just kind of going after, the run of your mill momentum names that, have good looking quality setups. And like you said, I've been bobbing and weaving. I've been willing to go long. I've been willing to go short this market. I've been trying to hedge things a little bit. I mean, this is really a great day trading environment. Scalp traders, definitely are thriving in this sort of environment because they have very little commitment to be long or short. They don't really look. They're not looking at the bigger picture. They're just looking at those key levels and flipping things in and out. The ones that struggle, swing trading is a little difficult because of that increased volatility. We know the trends are down, and you can capitalize on a move from time to time. But if you don't have the proper risk management and the proper position sizing, and you're too tight of a risk in this sort of environment, you're just going to get stopped out before things can actually start working in your favor. So it's just that's the real gist of trying to successfully navigate this market as it continues towards the lows. And that's really it. I'm just kind of keeping that short-term mindset, focusing on a day-by-day, hour-by-hour basis to capitalize on some quick little moves here. I don't think there's anything else I can add to what Brett and Gavin have already said in regards to this market's at extremely oversold levels. From a sentiment perspective, we're off the charts. From a breadth perspective, looking at names that are below the 50-day, 200-day moving average in the S&P. I mean, and RSIs and McClellan oscillators. I mean, just go through the list of technical indicators, and you're going to see we're at prior levels associated with other bear market lows going back to 2008, 2009, 2020. 2002 even on some of these indicators. So it's just a different environment. Fighting the Fed is not conducive to any sort of major investing portfolio. And I think a lot of the bigger players in the market, the institutions, recognize that. They've been around a much longer time frame than some retail traders over the last decade. And so while this might be the first, bear market for a handful of new participants, the big institutions, they know what's going on. They've known what's going on for decades, as long as they've been in business. So fighting the Fed is usually not conducive. So they're always going to be looking out a little further, to kind of discount everything and then kind of get in when things are really bad. That's pretty much it. I don't really have a whole lot to add down here. I'm just going to be continuously, you know, diving in on the long side and taking some trades, and diving in on the short side and banking some profits there, and keeping risk just really, really tight. So,
All right, Damon. Well, one of the things that Blue Chip said is that scalp traders are thriving in this environment. Would you agree with that statement?
Oh, hi guys. Yeah, I guess so. There's a lot going on right now, and I'm doing some scalping, but I see potential blood in the water, and I feel like things are setting up for some really compelling opportunities to buy distressed. And so I've been doing a lot of research, have really ramped up my research again, in preferreds and closed-end funds and publicly traded debt, and agency REITs, mortgage REITs. I mean, these are all the things that got crushed during COVID. February, March of 2020, some of these names fell 60, 70, 80%. I mean, some of the preferreds fell 60% in a day and recovered half of the losses by the end of the day. So I kind of feel like we have a setup like that potentially in front of us. And so for that process, for me, involves a lot of research and making sure I understand the names that legitimately might go under versus the names that will just be pulled down with everything else. And I want to buy the names that are going to be pulled down with everything else, but have strong balance sheets, have the ability to, survive such an event, right? So companies that don't have as much mark-to-market financing, have maybe more bonds in place that aren't necessarily impacted by a short-term sharp decline in asset values, and really just kind of setting up for those opportunities. Because I don't know, I feel like there's a train coming down the line, especially with the Fed just being really reluctant to kind of give it all. I mean, they're not really acknowledging any risk outside of inflation. And I think traders, hedge funds are in particular paying attention to that and feel like they can really drop the hammer on the markets.
All right. So, any particular sectors that you're looking for? Some of those distressed names that you're looking for that actually do have the strong balance sheets. Any areas?
Yeah, so I mean, really every group, you have a few names or many names that have strong balance sheets, and you have some that are, really weak. So for example, in the mortgage REIT space, there are some names right now that have seen dramatic declines in book value or net asset value. They're going to have to slash their dividends. They may start to get margin calls. And the first indication of a bankruptcy in that space will take everything lower. You'll see, major names down 40, 50% in one day, down 60, 70, 80% over the course of a few days. So that's what I'm looking for those opportunities to identify the names that will get hammered, will be pulled down with the weak names because there's a panic in the markets, and there might be an opportunity to buy things that have 100 to 200 to maybe eventually 300% upside, because a lot of these names will benefit once the Fed eventually does start cutting rates again to rescue the economy. The book values, asset prices will increase and will take these names up significantly higher. So really just kind of waiting for those types of setups, but importantly, understanding, being able to distinguish between the ones that could go under and the ones that are just going to get dragged down by the weaker names. But the mortgage REIT space in particular is very vulnerable right now.
All right, let's bring in Craig, trend tracker. How you been lately? Haven't heard from you much.
I'm okay, Jim. How are you doing?
Doing quite well. So what have you been up to? I know you were short some Tesla, and you were, let's see, you covered that position here today, and you've actually been doing pretty well on the short side. So what do you got brewing in the lab?
Yeah, I tend to cover a little early on the short side. I have been focused mostly on the short side for the last few months. It's just because that's what the market has dictated. There's been more opportunity on the short side. And obviously, as Brett mentioned, it's just becoming really crowded now that everything has kind of crashed. There aren't as many short opportunities here. As I've been saying the last couple of mornings, we may be getting close for a bounce here, but I don't really have much conviction in that, unfortunately. We've kind of been conditioned. So, we've seen V bottoms for the last 15 years. Going into in 2009, we saw a sharp V bottom. Every dip was a buy until the pandemic. We saw another very dramatic V bottom, and then last year things were just out of control in terms of a euphoric market with valuations that were out of control, and now we're kind of paying the price for that. And I don't think, inflation is an issue for the first time in 40 years. The Fed, perhaps when the Fed signals a pause in the tightening cycle at some point over the next 6 months, that can create a nice bounce. But, the monetary assistance that we've had that we're used to for the last 15 years is unlikely to come back. And without a resolution in Ukraine or a serious drop off of inflation, I'm not expecting a V bottom anytime soon. Estimates for next year are still kind of way too high, which I think is just basically how the sell-side analysts work. My data I'm looking at is still looking for about 10% earnings growth next year, which makes the market look a little cheaper. Mid-teens PE ratio on the S&P 500. But I think most economists are expecting either a soft or hard landing or recession next year. So I think it's kind of safe to assume that these estimates for $240 in EPS next year are very realistic. So I think maybe more flattish is a better assumption at this point, which means the market isn't really cheap yet at 16 or 17 times earnings. So there's a ton of stocks that I really like for the long term, and I've had that view all year. But if there's no expectation for a recovery anytime soon, I don't think there's a rush to buy. So there's a lot of stuff in the software, biotech, even consumer space that I do like. I added to Axsome yesterday, AXSM. They finally got their depression drug approved. They are going to report data for their Alzheimer's agitation indication before the end of the year. This stock has basically given back its FDA approval rally. That's my that's where I put some fresh capital to work this week. But you know, it's hard to have any conviction on single stocks when you expect the market to kind of be flat or even down over the intermediate term.
All right, want to open this up to questions. Maybe we have some open dialogue. Damon, you have something for us.
So yeah, I like to talk about the Fed. So you know, the Fed clearly has its tough guy face on and is not willing to acknowledge any risk, you know, outside of inflation, and wants to keep investors as well as I guess the general economy really focused on the inflation risks. What do you all think? How do you all think this plays out? Right, like the Fed right now is trying to position us, or you know, float the idea that rates are going to be higher for longer, and they're not going to flinch. What are y'all's thoughts on that?
I wouldn't mind going first on that, if that's okay. This is Brett, chart trader. I would say that there's a difference between what the Fed puts out publicly and what's going on behind closed doors, first of all. And I would imagine they've got multiple different plans, multiple different possibilities, but their public communications pathway is part of their policy. And until they see that there's a reason to change that, if they start to hint at something different, that is effectively stimulative, because future hikes are already pricing in to constrict financial conditions and risk acceptance, which is part of what they're doing to try to suppress inflation. I think to turn that bus publicly now, but behind closed doors, they probably have multiple scenarios they're planning for. And if we start to see, for instance, real, genuine financial instability. So one of the things I talked about a couple days ago in my notes is that there's this idea of like, well, what would be the signal? They're never telling us what it is we might see that would be the thing that might cause them to pivot, because they're saying it's actual price data, or it's like jobs data, and those are lagging indicators for sure. So when those things change, if there was an impending serious problem, it's already too late for the Fed to pivot, you know, in a way to preempt anything. So obviously they know that too. And so probably I think that radical financial instability, for instance, would cause them to come out and change their message. But there's already in the can lots of different possible strategies, but I think they take really super seriously that the words that they put out to the public are their policy. The future hikes are built into the messaging. And if they take the future hikes off the table by hinting at any possibility of a shift, any possibility at all, even just hinting in the slightest bit, it's gonna change right now how much risk acceptance there is, and it's gonna add to inflation. And until they're really, really sure, they're not gonna change their public facing side and the message they use, because that is their policy. So that's my view on it. I think that there are things that could change that would cause them to change that, and probably they've got plans for that. But it's a huge step for them to change that kind of messaging paradigm, because it actually is the policy. It builds in the future hikes.
Yeah, I'll jump in there too. This is Event Trader. Agree with Brett. I always kind of get annoyed when I hear the talking heads on the TV and stuff talking about how the Fed doesn't know what's going on and they're so unaware. It's not so much that they are unaware as their hands are tied with what they could say. And I mean, a perfect example of this is in the June meeting. I was listening to Powell hammer home the idea about the Fed needing to stay aggressive. Pricing pressures are the number one item out there, and they said, but if we see something ease, then we could slow down the pace, right? And what happened in the markets? We all of a sudden got a 2-month rally based around some false notion that the Fed wasn't going to be as aggressive with their price hiking thing. So that's where they're kind of their hands are tied in terms of what they could say and what they could do.
And then a worse CPI report.
Right, and then a worse CPI report, and everyone's like, "Oh, these guys don't know what they're doing," and all that stuff. So, they're very limited on what they could do on the forward guidance, and I do caution people: these aren't dumb people that are running this. These are very smart people, very well educated, understanding the economics and financial markets out there. So, just realize that. But in terms of the Fed being able to keep their current path, it's certainly financial conditions will be the number one bugaboo. The stock market price action, that's not going to force them to act. But of course, the problem with the stock market is it probably will be reactive to financial conditions. One of the charts that I was showing earlier this week was that dollar sign move chart, which we talk a lot about the volatility in equities through the VIX. But that move chart, that's volatility through the bond markets. And when you see that at all-time highs in that tracking index, that is a sign that the financial markets aren't working properly. And that's what's going to cause the Fed to eventually move at some point. Now, the question is how much of this financial instability and economic instability reigns in inflation and allows the Fed to get away without having to hike rates as aggressively as they want. That's going to be the big question for the markets out there. But as of now, the Fed's just kind of doubled down on their strategy, but they're well aware that they might need to pivot at some point. They were aware in 2021 with inflation coming through. Now, in their defense, that they were a little bit thrown off with Russia, Ukraine, and the China zero COVID policies. I think if you want to see anything that would be disinflationary, it would hopefully be when we get past China's November congressional party and they decide to do away with the ill-fated zero tolerance policies for COVID. That would be a big deflationary event that I don't think that the market's really positioned for. You can say the same thing about Russia and the Ukraine invasion. Everybody's situated for that to get worse, and that's certainly the possibility with tactical nukes now being brought to the forefront and everything. But the black swan in this particular case would be if all of a sudden Russia and Ukraine were able to come to some sort of agreement on a peaceful term. That would also be disinflationary. So there are things that I think that the Fed is hoping will help them out, but in general, they got to keep on with their current language and past what keep that language past with what they need to be, just because of the very fact that the market just overreacts too much to what they say if they try to provide a case that makes sense. And in this case, it would be if things get worse, or well, of course we could slow down the size of our purchase or the size of our hikes, but after the June experience, they're going to be a little bit slower to do that, and that's kind of the problem here.
This is Craig. Yeah, I mean, if we go back to the first half of August, where the euphoria got out of hand again, and it was basically 2021 there for 2 weeks. Every short got blown out, and it reinforced. We were saying this too. It reinforces the Fed had to stomp out all this crazy speculation, and since then, the news flow couldn't be worse. Not only did Powell, double down on his hawkish stance, but Russia cut off gas, and then we had a higher inflation print. So, I just even if they do pause at some point, I don't know. The more I look at, a longer term chart of the SPX to the QQQ, it just seems like we are probably going to, we were headed for a test of the pre-COVID high at least, right? I mean, if you look at the longer term chart, it just kind of seems inevitable, given all the headwinds we have. I mean, the situation in Ukraine only continues to escalate, and hopefully there is a resolution and the right side wins. But it's going to be messy. I mean, it's not like it's just going to go out with a whimper. the Fed can't allow, as Brett noted, if the market starts ripping, it just makes inflation more of a risk again. So, yeah, that's my view on it.
All right. Are there any other stones that we need to turn over here? And here's a great platform since we have all you guys together. Anything that we need to address?
I'll throw out a question. Is there any one particular area in the market that anybody sees opportunity, or is everything completely a washout? I'm just curious if like pullbacks in energy, if people are watching for that. Damon, I know I'd be curious to hear a little bit more about your thoughts on some of these troubled assets and what you're looking for in that front. Is there any particular area that you're paying close attention to? So that's what I'd like to know from the team, if there's any sort of light at the end of the tunnel that you'd be interested in.
I'd say emerging markets. Again.
Already, Brett?
I don't know if it's right at this moment, but it's already completely washed out. We've already gone through, like 17 years of no growth in value, despite a lot of real world growth and potentially the highest growth global factor play ahead. And we're already, and obviously it's because of risks. It's obviously, the dollar denominated debt and worse infrastructure and a deteriorating, geopolitical environment, and et cetera. There's a lot of risks that are causing things to be, that compressed in terms of like, valuation of any given company in terms of future growth potential. But, around the next corner, there's still something there. So I still don't understand exactly how to implement it. And I don't understand exactly the timing, but we're in an intensification of a particular dynamic in terms of global sovereign debt and in terms of currency markets that exacerbates that kind of downside potential and is keeping the pressure on, and it's just kind of intensifying the value opportunity there. And at some point that storm is going to break.
Have you done enough research to identify which emerging markets you'd like to look at? Because historically, when we've heard emerging markets, a lot of the ones that came to mind would be China and Russia, Taiwan. Those would be some, but those would be ones that I think would probably want to be cautious. Right?
I don't know about that, but it's tough to find. What I'm not interested in is effectively like global technology mega caps that just happen to be based in China. A portfolio including Tencent, Alibaba, and Taiwan Semiconductor as the 50% of the exposure. Like that's not what I'm interested in. But it's tough to find a basket product that's really going to do that. And I expect it's a collection of different, more niche ETFs that don't include China. Asia's fine, but particularly where you don't have such a specific country-based narrative that's apart from the types of dynamics I'm trying to get at. So it's difficult in implementation, especially to express it in a way for like our subscriber base to have easy access to it. But it's something I'm still working on. And, any help would be appreciated if we want to crowdsource this, but you want to find exposure to, South America and the Middle East, maybe even Eastern Europe and Africa and areas where you have a lot of dollar denominated debt. And once that tide breaks, it's a complete game changer. And you have a lot of just complete risk aversion, just pulling capital, global capital, just pulling out of any sort of exposure to something that may be in terms of its own infrastructure and in terms of its relationship with receiving, some side of their equation in terms of goods to run their economy that's become more difficult with supply chain issues and all the risks involved, and political risks, and where there's just been capital's just pulled out, it's just left for dead, even though you tweak the environment just a little bit and you're talking about like thousands of % growth potential over a decade. And again, these things have been basically showing no growth in terms of the valuation of assets related to companies in those types of markets for like now 16 years. So they've just been wasting in this kind of, missing out on everything that's happened in basically every other asset over that period. and now it's intensified. So if we can find a way to do it, and it's a reasonable implementation that takes into account those sorts of dynamics, without just basketing exposure to just like again Taiwan Semiconductor and Alibaba and Tencent.
Yeah, Brett, I did just find two EMX China ETFs, and it's EMXC and EXCEM. But
Sure, I've looked at them.
both of them, yeah, like you said, it's Taiwan Semi, Samsung, top heavy. I mean, at least their trend is good, but yeah, it's kind of more a lot of the bigger mega caps, which isn't ideal.
Would it make sense to play maybe in the foreign exchange markets, Brett?
It's possible, but again, I'm hoping to figure out a way to suggest an implementation that's going to be something that's easy to
easier than that,
easy to access, so that it's something that we can all take advantage of.
To answer Damon's question, or was it Gavin's question? The light at the end of the tunnel. I mean, if you look at both biotech and the software space, we have seen a lot of M&A this year. There is a lot of money on the sideline that is willing to step in, whether it's private equity and reasonably valued software stocks, or the big biotech, the big biopharmas that are constantly acquiring the smaller players. If you look at like the IGV or the XBI, they had big blow off tops last year, and now they've kind of come in to where they were for 5 or so years before last year. So there is a lot of long-term support on both of those charts. So there is a lot of value, and there is capital that's waiting to kind of pounce on a lot of this stuff. But if you're talking about a software company that when IPO last year it was trading at 50 times sales, and now it's trading at 7 times sales or 10 times sales, I mean, not sure there's going to be a buyer, and we're probably not going to see 40 times sales again anytime soon. But in those secular growth stocks that went crazy last year, there is value there, but it just seems like the crap will continue to hit the fan near term, but there is opportunity there for sure.
All right, gentlemen, anything else that we need to cover?
I wanted to jump in and get thoughts on oil. I mean, obviously we've had big pullback despite some of the structural issues with the oil market. What seems to be a lot of concern about global economic slowdown. What do you all think? Well, oil and natural gas. We've had a significant pullback in both. Obviously, we just had the pipeline. Was it two pipelines that were blown up?
One permanently, I think.
Okay. So yeah, what do we make of that in terms of the outlook for oil and natural gas prices? And because I think there could be an opportunity there in terms of the individual stocks as well as the ETFs if there's a sense that maybe we zip back higher in either one of those, oil or natural gas.
So I can go first quickly. I'm in the same position that I was in last time we talked about this, which is there's a dynamic playing out over one time frame, and there's a different dynamic playing out over the other, which was implicit in the way you worded your question. And it really is the structural situation is again I would make the case, and it's just shock value when I say it maybe, but I kind of don't think it's purely shock value to say that I can see 5 years from now $300 oil. Like there's been no investment, and it's actually gotten worse and worse and worse recently rather than better and better and better. And there's a real possibility that we're going to head to a place where oil is just so structurally undersupplied, and I think that because of that, there's a lot of people that buy into that same thesis, and so you've seen a lot of positioning around that. And so right now you have this difficult dynamic where if we head into a global recession over the next few months, and this what's going to happen in Europe is a huge wild card. And whether or not, they really, let's say the EU countries can't really figure out a way to make this work. And instead they just, they're just see like a 8% GDP drop in a quarter or something. There's no way you're going to win on a long side oil play over that time frame if that's the case, especially since there's a lot of people who are long oil because they see the same structural situation that I do. And so it's really about navigating the timing, and those are really dependent upon how a lot of other factors play out. And it's really tricky. I mean, I could advocate, for instance, to find a way to be exposed, and like dollar cost average in USO or something. I mean, we don't have that contango problem anymore. USO is now an instrument, and it's difficult to see contango just suddenly entering the picture with the structural supply situation. So something like an ETF that's directly in oil, you don't have that contango decay, and that's open season if you want to like dollar cost averaging or something with small sizes. I think that's not an unreasonable strategy at all.
Brett, I think you get a little bit in the same conundrum that you were talking about in the equities markets, where you want to be short, but it's a crowded trade. In
this case, it's the opposite, but yes.
Yeah, it really is. But then you also, if we do enter a recession, that would be negative on oil and demand. So
Sure.
It's
especially since it's crowded to the long side. Yeah, you're going to have some
right.
But boy, that's the buy, right? So it's like, do you buy it now? Because what if that doesn't happen? It's an uncomfortable situation. And maybe you kind of have sort of a barbell approach, which is a small size exposure. So you've got something there, but you're still, and this is kind of like, right up Scalp's alley, Damon, your strategy of entering certain positions where you're able to establish some kind of exposure. And then, but you've got the feeling that there could be some kind of transition to a situation where it becomes, much more, a much better value proposition at a lower price, and instead of hitting a stop and puking you out, you've got the ammo to really take advantage and average down. And I'm not terrific at that. That's just that I've got my skill set, I've got my strengths, and averaging down is not one of them.
All right. Any other parting shots we got?
Okay, I have one more question.
Oh, go ahead. Yeah.
So natural gas flowing from Russia. Do you guys think Europe ever takes Russia's natural gas again? Or they just completely diversify away?
Yeah,
and say, hey, we're done with these guys. Can't you?
No, they will. They will. One of the emerging market winners from this whole thing that I would just point out, the Brett, a name that I like, is India.
Yeah, I agree. No, I get you. Yep.
We're just to kind of throw in for the other answer, just because they import so much of their energy, and they've been still buying from Russia. They're not tied to some of the Western accords out there. So, but in terms of how this situation plays out, at some point, I think Putin and Europe can't coexist. So there's definitely going to be that aspect of it. But, the common politics makes strange bedfellows. You never know how this is going to play out. With Italy, for instance, we had the far right take over, and they are a little bit more in tune with Putin, and a little bit more on the authoritarian side. So, we're going to have to see if that NATO alliance starts to crack a little bit over the winter, when the reality of people not having heating gas come into their houses, how does that change the perception of everything? That's definitely going to get taken into place. And I think what you could see play out is this 15% annexation of Ukraine, Europe kind of leaning on Zelensky a little bit for him to accept it as the best case scenario, try to get in some accords there on Putin promising not to take one more step further, similar to what we saw with Hitler, I guess, in the 30s with the Danzig area and stuff with Czechoslovakia, and see if that goes, which could ease the situation for a little bit here. But I think at some point, you will see Russia and the EU once again working together for delivering energy. But that sabotage of the pipeline, that's definitely a next level thing that we're going to have to watch to see play out. But it's either this: they're either going to get back on the same page, or we're going to have World War III, and I don't see much of a middle ground there.
Well, there's one other black swan possibility, which is an outside shot, but that would be regime change in Russia.
Right, very true. I haven't seen any sort of hints of that, and Putin's pretty well insulated, though. Brett,
No,
wouldn't you
sure,
think?
yeah.
But like you said, that's why
Impossible.
it's a black swan, right?
Yeah.
If it was a base case scenario, we'd be talking about it a lot more, I suppose. But yeah, that would be another obvious game changer.
Well, if that was the base case scenario, I'd sure we'd be running right into a short squeeze and trading all-time highs again. So
Yeah. I
And
mean,
nat gas diving lower, and
yeah, right. All right. Okay, this time, fellas. Anything else? Parting shots. What do you guys have?
well, I'll start off. So just to throw out a couple of names that I'd be watching going into earnings season for some possible strength. These are all companies that have 0% of sales outside the U.S. and names that I'll be watching. The communication services sector, that's gotten beaten up pretty good. You got Charter Communications, Fox in there, T-Mobile, Verizon, Dish. There are a few names that I'll have on my radar if we do start seeing a little bit of a bounce going into earnings. Some consumer discretionary names to watch would include Dollar General, Chipotle, Ross Stores, Target, DR Horton too from the housing side, no international exposure there. A few staples, Altria, Kroger, Constellation brands, keep them on your radar. On the energy front, you got Devon, Pioneer, Natural Resources, and Marathon Petroleum. There are a few names to keep on the radar. On the financial side, Wells Fargo, they're going to get crushed by their mortgage originations, but keep an eye out as they are domestic only. PNC, Capital One's another one to keep an eye out on. A few healthcare names I'll throw on the radar: Centene, Quest Diagnostics, and Humana. I'll post these to the website too. On the industrial side, Norfolk Southern, CSX as well, and Southwest Airlines too. They're purely domestic here. I think that you'll see some strength going on that front. And then on the IT side, not a lot without international exposure, but a few with a little less. CDW, Enphase, ENPH. That's a one with low international, and Global Payments, GPN. And then just one more to throw at you on the materials side, Nucor, NUE. So there are a few names that I'd be throwing on the list for some potentially better than expected earnings coming up in the next few weeks.
All right, that's a nice list for us. Anyone else regarding earnings or any other trading tactics?
Just watch the financials to bounce going into quarter end here this week. I think with the earnings season kicking out mid-October, we could have a lot of these beaten down banks like Citibank, Goldman, Bank of America. They've been all pretty hard hit here the last 2 weeks, probably down about 15-20% off the September highs. And if there's going to be any sort of recovery effort going into early October, I'm going to be looking to scoop up some of these banks.
All right.
Yeah, I have a comment. So with the banks, right, you're seeing the spreads improve. Obviously, there's some concerns about assets, loans outstanding, and having to take marks against those loans, build reserves. Gavin, you really follow this space in particular. What are your thoughts on financials? When I look at my bank, I think I'm probably still getting 0.5% on my savings account, and they're loaning money out at 7-8% or wherever. So obviously those spreads have widened significantly. What are your thoughts on the financials, the banks in particular?
Yes, so we got Jeffries out last night, and so it gives us a little bit of an understanding. We had the Barclays Financial Services Conference earlier in the month, and we got some guidance there. So a lot of negativity has been priced in. We're certainly looking at a decline in revenues on the top line. Loan growth is expected to see a little bit of a pull in. Obviously, when you start getting these higher rates, people simply aren't demanding loans. Certainly, mortgage originations, we know they were just at a 22-year low, I think, or mortgage refinances. They were at a 22-year low. Mortgage originations in general, they remain low. Auto loans, there was a particular area of weakness that people were pointing out. So uh, that'll be a drag. So names like Wells Fargo that get the majority of their earnings from that, Bank of America, it'll be curious to see how strong the net interest margin and net interest income growth are when you're looking at the potential for um, some top line slowing. The investment banking units, there's been a lot of volatility. One would expect them to perform well around this, but the fixed income markets have been very difficult. We've seen a lot of write downs going on, as Brett had noted. One of the particular issues that the Bank of England was running into was a lot of these big pension funds having to write down their mark to markets and getting margin calls on a lot of their bonds, because the bonds are just getting decimated with those yields running. So these are all things that all the major U.S. banks are going to be dealing with. And on the flip side there, equity, obviously the underwriting is going to be a lot slower there, not as many IPOs or anything. So but the trading volume should have been a little bit better, and that should be something that they benefit from. So I think the thought process around the banks has been pretty well laid out. What the question is going to be is, have the book values gotten to a point where people feel comfortable enough with them? They're very cheap right now, but we got to see what type of write downs people are taking and how that impacts their book value per share, and what, very similar to what we have with the earnings aspects going on. We've got a forward PE lined out, and we understand that it's 230 and 17 times, but does that hold water, or should the forward PE for the SPY be closer to 220? In which point, then you get a more expensive market. And the same holds true naturally on the book value per share for these financial institutions. So the other thing that we'll have to be keeping a close eye out on when they get into earnings season is reserve builds, where we've seen a lot of the commentary around Barclays was that they weren't planning on doing any further releases, but they also weren't looking to do builds. If all of a sudden we start seeing them do builds, then why are they building up their reserves? What are they seeing out there that we need to be cautious on? And that will naturally turn an eye to the credit side of things, which has remained benign for the longest amount of time. But we are starting to see signs creep up. For instance, my one buddy who's a realtor, he's been getting calls nonstop from banks looking to see if he'll do some foreclosure work for him. So, we are starting to see a little bit more signs with those rising rate environments of that picking up. So all these are going to be factored in for the banks. But I think, as Scott was saying, sentiment's so low that there is certainly some room for some upside there. So, and the valuation is definitely attractive. So something for us to watch. But again, if people are concerned about a recession coming, that makes the banks pretty difficult to buy.
I got one question for you, Gavin.
Sure.
Okay, this is just off the wall. It just occurred to me. When we did our last sentiment and flow show, you know as well as I do that the one thing that we know for sure is that major Wall Street players have been super bearish on both stocks and bonds.
Right.
And for months now. Is that because it's a weird sort of recursivity with looking at financials versus any other sector, because part of their success also has to do with what their strategy has been where markets are concerned, right? So how important is that? Like how big a piece of the puzzle is it if they just had an amazing trading quarter? Because they've been right on the market big time.
Well, I mean, certainly revenues and the bottom lines, we've seen that from Goldman in the past. Goldman and Morgan would obviously be the biggest impact on that. Now, again, we just had Jeffries come out and their results were good, but certainly didn't blow away any expectations. Because here's the thing: for them, it's more about the volatility
And
than being right.
volume and
Yeah,
volatility,
because
right.
if they're doing it right, of course, if
Yeah.
they're hedged correctly, certainly you'll see like the JP Morgan whale trade where they lost $6 billion. And,
Right.
there's pockets of that for sure. Does that increase given the volatility that's out there? For sure.
Right.
Somebody with a hedging program, like you said, that might have been set up for 2014 through 2018 and worked great and was the belle of the ball and really provided some good results. Maybe this time around, it's not acting as proper the way it should. And that's where you see a lot of these troubles come in, where people just kind of set a program to go. And then it's too late and they realize that the program that they had, they forgot to carry the one or whatever it might be. But for the most part, they are more about volatility, which
Right.
should suggest elevated, because again, if they're selling puts, right, then they're shorting stocks to hedge that put selling. So
Yeah.
it's not like they have that naked exposure that, oh, if the market goes up, they're
Sure.
doing well or anything. So for my perspective, it'll definitely be an emperor's got no close moment potential for the Q3 investment banking unit. If some of them have been really positioning themselves poorly, especially those with bigger exposure to the fixed income side, which is where we saw a lot of mark-to-market write-downs from Jeffries. So from that aspect, it'll certainly be interesting to see how it plays out. But for the most part, I'm not expecting it to be a major revenue boost or earnings boost per se at the moment. But it remains to be seen. And as we start getting some of the numbers in, it'll be certainly something that we're taking a close look at. But for the most part, it's properly hedged investment bankers shouldn't really see much of an edge on a big upside or downside, just as long as there's the volatility there.
Yeah, I guess I was thinking more at the margin in terms of if you have a directional assumption that's correct, just in terms of how you execute on that volatility. But yeah, I get what you're saying.
You're asking me, or you're
Well, I'm just clarifying. I'm not saying just because they've got like $5 billion put position for the last month, but just in terms of how they handle facilitating those transactions, that they just have a slight edge on every one of them if their directional assumption ends up being correct.
Yeah, you'll see that a lot will be in the VAR number to see exactly how much they're risking, which I'm expecting is going to be pretty low. Which Scott talks about it all the time, right? The higher the volatility, the lower size that you want to go with. So, I guess that would offset some of the some directional correction, just being a little bit lighter on the
right.
On the volume side of things. So, and then just from the margin aspect, like they'll never have a huge short position that's naked that they're making a killing on.
Sure.
It's not like, for instance, Amazon with their Rivian holdings, right? They hold what is it, Craig, 18% of Rivian or something like that, and you can see massive swings in their net income based around the price tag of Rivian. You don't really get that as much with the financial institutions, just because of the hedging nature, and if they're doing it properly, of course.
That makes sense.
Okay, I have one last question. It's for you technicians out there. Like, how low do you like? I look at my screens and there's just not the only thing that I see that excites me is further downside, right? Like, I see things that are extremely vulnerable. They're falling and they look like they're just going to keep going down, which excites me, right? Because eventually they'll overshoot. How low do you all see us going? I mean, I don't, maybe I'm just too bearish and we're going to set up and bounce tomorrow, but I just don't see any safety net, anything that kind of hold us, that gets one excited, whether it be valuations, and technical levels. I don't know. What do you all think?
I mean, I can go first and just say the sentiment situation is this disruptive element in that picture. And like you, I think that there will be more downside. I just feel like there's got to be some pressure relief valve to rebalance positioning. So it could be more time consuming to get that next leg, because I don't understand how people could be positioned with a greater assumption of downside than they are right now. But maybe there's a big wave of like redemptions on the household side that changes that picture, which makes some sense. But I guess if I just had to throw out like some level, I think there's like a zone around 3250 that looks interesting to me, where you kind of feel this sort of 62% correction of the entire post-pandemic rally. You've got a lot of big levels through there. You go back under the peak of where the market was right before the pandemic. Just from sort of an S&P technical standpoint, I could see that being kind of like an Elliott serial WXYZ kind of zigzag that takes well into next year, especially given the sentiment situation.
Yeah, I would just say, Damon, just the fact that when you throw out sentiment like that's definitely where we kind of maybe get to that flush, right? Where people are just at a wit's end and don't see any sort of way around the decline. And certainly there's some areas here that are setting up that I'm watching. If we flush down, number one would be 35.21, which I have as the 50 monthly moving average. I think that sets up as a pretty key area. The other level that I'd be watching would be right around 3,400. And what that is, that's the highs in February 2020, which of course would have been right before the pandemic started really impacting global markets. So there are two areas that I'm just kind of watching for possible flush activity there. And naturally, Brett's 3250 is one that I'll be adding on. But that's levels that I'm watching and the reasons why I'm watching them.
Yeah, Damon, let me introduce you to something called the swing trader column. I don't know if you've ever read it before, but it's been out there for a while. And I did highlight recently the levels on one of the many charts that I posted. I think you actually commented on me too. I think you actually said you breezed through it real quick. But yeah, for sake of playing devil's advocate, I assume the 50% retracement off the COVID crash and this year's high comes in around 3,500 on the S&P. And I think that's a key level that a lot of institutions are monitoring. It's just a 50% retracement, 3,500. So that's super important to track right now if we do start to collapse underneath 3,600. Now, as Brett mentioned, sentiment is so tricky. The market, we don't know if we're going to get one of these multi-day gapping down scenarios where the market just goes into a climatic sort of distribution, baby in the bathwater scenario. If that is the case, I would be looking somewhere around the 3,200 level, which also lines up around Brett's 3,250, I think he said. That's about 3,200, 62% Fibonacci retracement off the COVID low. And I think a lot of technicians are just kind of eyeing that one up as a worst case scenario. The key thing really, though, is how we get down to those levels. The faster we, rip the Band-Aid off and experience pain and accelerate to the downside, well, then I think we're going to have more of that, capitulatory V bottom that so many people seem to be expecting to occur at some point. Now, if the Fed is going for their soft landing, then maybe it's just going to be, I think it's growth recession. If they're going for their growth recession now, I think maybe we can actually have, this bounce going into Q4 of this year, maybe sometime in October, November, and then we just start to peter around again. We stay below the 200-day moving averages, and we just start to gradually go into more of this prolonged bear market into 2023 with a lot of lower lows and then rebounds and lower lows and rebounds that are basically going to stair step their way down towards that 3,500, maybe even 3,200 level over time. And that's going to be actually real reminiscent of bear markets that we saw back in like 2000 to 2001 timeframe, as opposed to a lot more of the V bottom sort of behaviors that we saw in like 2002, 2008, and 2020. So it's tough to kind of say how it's going to play out. As Mark Twain said, history repeats itself. History does not repeat itself, but it often rhymes. So I do think we're going lower. Just it's going to be difficult to kind of figure out how we get down to those levels and at what point in time. But I would just say 3,500 is going to be the first close target on the market here, probably in the next few weeks if we do continue lower. And then if we get that more capitulatory, look to 3,200.
Yeah.
Okay,
I
good
would
stuff.
agree with that. The pre-pandemic high was almost 3,400, but if you look at about 3,200, there was a lot of congestion there in the summer of 2020, and it probably won't be in a straight line. Hopefully there's no catastrophic headlines where we do see a sharp flush, but yeah, I think it's going to kind of take some time, lower highs, lower lows. So I am kind of assuming 32-ish will happen on the S&P.
Yeah, I kind of feel like we're positioned for some type of catastrophic headline to wash us lower, gap us down dramatically, and that's when I start to get interested again. I mean, there are names that are on my radar that if they fell another 20 to 25%, they would be really intriguing to me. But they're not that attractive right now. But if they got hit 15, 20% on a gap down and then fell another 5, 10, 15% the next day, I could foresee opportunities to make a quick 20 to 40% off of them, especially if you get some type of major kind of capitulatory buying interest in the market. So that's what I'm waiting for. I kind of feel like that's on the horizon for us potentially. So.
Hey, if you were writing a fiction story of the future of this, what would be the headline?
Keep your powder dry because.
No, I mean the headline, the catastrophic headline.
Oh, catastrophic headline.
What's the thing that's going to go so terribly wrong?
I don't know. I feel like the hedge funds are out there, the macro funds are out there searching, and they're looking for the points of vulnerability, and they're gonna break some things, and they can go from country to country, from continent to continent, and it only takes one or two headlines to start things spiraling, and then you just kind of look around you and pick at the countries around that area, and then it possibly goes to another continent. And so I just think that we're just in a market, we're in a really vulnerable position right now. And one of the reasons I'm asking all these questions is because I think there could be tremendous opportunity, and I'm just trying to look around and see, what could be coming at us, and just be prepared. Like, I'm super cash heavy right now, and just historically, these types of environments are where you really get very well. So I want to make sure that I'm fully prepared to generate ideas to take advantage of this type of scenario.
Sure.
Well, I'll say this much. Historically, when we've had some major crashes, they've occurred in October, and that's just a couple of days away. So who knows? Maybe you have a prophetic scenario going on there, Damon.
Yeah, we'll see.
We'll see. All right. Well, I think is that a good place to wrap it up?
I think so. Nice and dark.
Yeah, of course. Well, guess what? We'll be back in about a month. And by that time, we should know if there's any October crash. And I'm sure we'll have some updates and lots of things we're going to be able to talk about on that one. Until then, gentlemen, thank you so much for joining us today. Lots of good insight, lots of good input, and appreciate it. And I'm sure the listeners appreciate it as well. Thank you.
All right, talk to everybody later.
Thank you.